A headline from China sent investors searching for answers. Reports suggested that major Chinese banks were restricting parts of the gold trading market. Gold prices were already near record highs. Central banks around the world were buying gold at an unusual pace. Investors were nervous. And suddenly, one of the biggest gold markets on Earth was changing the rules. But this story is not really about gold. It is about power, fear, money, and a financial battle that could affect the entire world. To understand why this matters, we need to understand one simple thing. People buy gold when they stop trusting something else. Sometimes they stop trusting stocks. Sometimes they stop trusting governments. Sometimes they stop trusting currencies. Gold has survived wars, crashes, recessions, and financial crises. That is why people call it a safe haven. When fear grows, demand for gold usually grows too. China is not a small player in the gold market. It is one of the world's largest consumers of gold. The country also holds thousands of tons of gold reserves. In fact, China's central bank has continued increasing its official gold holdings, adding more gold to its reserves in recent months. So when investors heard that Chinese banks were restricting some forms of gold trading, many people became confused. Why would a country keep buying gold while making trading more difficult? The answer starts with a problem that appears again and again in financial history: speculation. When prices rise very quickly, people stop buying because they need something. They start buying because they think prices will keep going up. That creates a dangerous cycle. More buyers push prices higher. Higher prices attract even more buyers. Eventually, people begin taking bigger and bigger risks just to stay in the game. That is exactly what worried Chinese banks and regulators. Reports showed that several major banks started limiting or shutting down certain retail precious metals trading services. Some banks raised requirements. Others stopped accepting new customers. The goal was not to ban gold. The goal was to reduce risky speculation by ordinary investors who were betting on price movements. But this raised a much bigger question. If China is trying to calm its gold market, what does it know that everyone else does not? At first, this might not sound like a big deal. Banks change rules all the time, but investors started paying attention because of the timing. Gold prices had already experienced extreme volatility. Some Chinese banks raised margin requirements. Others stopped offering certain precious metals trading products altogether. Large institutions were trying to reduce risk at the exact moment when many retail investors were rushing into the market. That made people wonder if something bigger was happening behind the scenes. The internet quickly turned the story into something much more dramatic. Some people claimed China had banned gold. Others claimed China was preparing for a financial crisis. Some even suggested that China knew something terrible was about to happen to the global economy. The problem was that most of these claims were not true. China was not banning physical gold ownership. People could still buy gold bars and jewelry. The restrictions were aimed mainly at certain retail trading products and speculative activity. But even after removing the rumors, an important question remained. Why was speculation becoming such a concern? The answer goes back to one of the oldest patterns in financial history. Every bubble starts with a good story. People hear that an asset is rising. More buyers arrive. Prices go higher. Then people stop asking whether the asset is worth the price. They only ask how much higher it can go. That is when markets become dangerous. It happened with stocks. It happened with housing. And it has happened many times with gold. Gold is different from most investments. A share of stock can produce profits. A business can create products. A bond can pay interest. Gold does none of those things. Its value comes mostly from trust. People buy gold because they believe someone else will value it tomorrow. That makes confidence incredibly important. When confidence rises, gold can surge. When confidence disappears, prices can fall much faster than many investors expect. Now imagine being a regulator watching millions of ordinary people chase gold prices higher. If prices suddenly crash, those same investors could lose large amounts of money. Governments and banks know that financial panic can spread quickly. One bad market can create problems in other markets. So from the regulator's perspective, limiting risky speculation is often easier than cleaning up the damage later. That is one reason many analysts believe Chinese banks started tightening controls. But there is another layer to the story, a much bigger layer. Because while some Chinese banks were restricting certain forms of gold trading, China's central bank had been building its gold reserves for years. Around the world, central banks have been buying large amounts of gold. Why? Because many governments are trying to reduce their dependence on the US dollar. Gold has become one of the most important backup assets in that strategy. This is where the story stops being about investors and starts becoming a story about countries. For decades, decades, the US dollar has been the center of the global financial system. Oil is priced in dollars. International trade often uses dollars. Governments hold dollars as reserves. That system gives the United States enormous influence. But some countries, including China, have been searching for ways to reduce that dependence. Gold plays a role in that plan. Think about it like this. If you're a family and you keep all your savings in one place, you become vulnerable if something goes wrong. Countries think the same way. They diversify. Some reserves are held in dollars, some in euros, some in government bonds, and some in gold. The more uncertain the world becomes, the more attractive gold looks. That is one reason central banks around the world have remained interested in it. So now we have a strange situation. On one side, Chinese banks are reducing certain retail trading activities. On the other side, gold continues to play an important role in long-term national strategy. That creates confusion. Are these actions contradictory, or are they actually part of the same plan? Understanding that difference is the key to understanding what is really happening, because the real story is not that China is abandoning gold. The real story is that China appears to be separating investment from speculation. In simple words, officials seem comfortable with people owning gold. What they appear less comfortable with is millions of people making highly leveraged bets on short-term price movements. That distinction may sound small, but it changes the entire meaning of the story. But if gold is so important, why not simply let everyone buy as much as they want? The answer is that governments do not only care about prices, they care about stability. Imagine a stadium with 50,000 people. If one person starts running toward the exit, nobody cares. But if everyone runs at the same time, panic begins. Financial markets work the same way. Regulators worry less about gold itself and more about what happens when millions of people suddenly rush into the same trade. That fear became more serious after gold experienced one of the wildest periods in recent history. Prices surged to record levels and then fell sharply. Some reports showed gold losing nearly 30% from its peak. When prices move that violently, leveraged traders can lose money extremely fast. Chinese banks responded by tightening controls, raising margin requirements, and reducing access to certain retail precious metals trading products. Think about a simple example. Imagine you have only $100. Instead of buying $100 worth of gold, you borrow money and control $1,000 worth. If gold rises, your profits look amazing. But if gold falls, your losses become much bigger. This is called leverage. It makes good times look better and bad times look much worse. Regulators around the world have worried about leveraged speculation for decades because it can turn a small market correction into a financial disaster. This is where many people misunderstood the story. The headlines suggested China was turning against gold, but the evidence pointed somewhere else. Major banks were mainly targeting speculative retail trading linked to precious metals products, not physical ownership of gold itself. Investors could still own gold bars, jewelry, and other forms of physical gold. The restrictions were aimed at risky trading behavior, not at gold as an asset. And that creates a fascinating contradiction. At the same time that some retail trading products were being restricted, China's central bank continued treating gold as an important strategic reserve asset. To many observers, that looked strange. Why would ordinary investors face more restrictions while the country's financial system continued paying close attention to gold? The answer may reveal how governments think differently from individual investors. Most people buy gold because they want profits. Governments often buy gold because they want protection. Those are completely different goals. A trader may hold gold for 6 months. A central bank may hold gold for 20 years. A trader worries about next week's price. A government worries about the next financial crisis. That difference changes everything. To understand why, we need to talk about the US dollar. For decades, the dollar has been the most important currency in the world. Countries trade with it. Banks settle transactions with it. Governments store reserves in it. The dollar became the foundation of the modern financial system. But every system creates winners and losers. And not every country is comfortable depending on a system controlled largely outside its borders. China has spent years trying to reduce some of that dependence, not because the dollar is about to disappear, but because relying too heavily on any single system creates risk. Imagine if all your savings, your job, and your house depended on one company. You would probably want a backup plan. Countries think the same way. Gold is one of those backup plans. That idea became even more important after major geopolitical events over the last few years. Governments around the world watched how financial sanctions could affect countries, reserves, and international transactions. Suddenly, holding assets that could not easily be frozen became much more attractive. Gold does not need an internet connection. Gold does not need a bank account. Gold does not depend on another country's promise. That is one reason many central banks increased their gold holdings. Now the story becomes much bigger than China. Around the world, central banks have been accumulating gold while retail investors chase headlines. One group is thinking about the next quarter. The other group is thinking about the next decade. And when those two groups move in different directions, smart investors pay attention, because sometimes the biggest clues in finance are hidden in what governments do, not what they say. That raises an uncomfortable question. What if China's restrictions are not a warning about gold? What if they're a warning about speculation itself? What if regulators believe that too many people have started treating investing like gambling? If that is true, then this story is not really about China. It is about a problem affecting financial markets everywhere. History is full of examples where excitement replaced logic. During the dot-com bubble, people bought internet companies that barely had revenue. During housing bubbles, people believed home prices could never fall. During commodity booms, investors convinced themselves that prices would rise forever. Every generation thinks its bubble is different. Every generation eventually learns the same lesson, and that lesson is simple. Markets can stay irrational for longer than people expect, but eventually reality wins. The question is whether investors recognize that reality before or after prices change. That is the challenge facing millions of traders today. Not just in China, not just in gold, everywhere. By now, the story looks very different from the headline we started with. China did not suddenly ban gold. China did not declare war on precious metals. Instead, major banks appear to be reducing exposure to speculative retail trading, while gold continues to play an important role in long-term financial strategy. And that leaves us with one final question. If governments and central banks continue treating gold as a strategic asset while ordinary investors are being pushed away from risky speculation, what are they seeing that the rest of the world still hasn't noticed? Thinking face. The deeper you look into this story, the less it looks like a gold story, and the more it looks like a confidence story. Financial systems run on confidence. Banks need confidence. Currencies need confidence. Markets need confidence. The moment confidence disappears, panic takes over. That is why governments watch speculation so closely. They know that when people stop making rational decisions, markets can become dangerous very quickly. Think about what happens when a rumor spreads online. One person posts it, 10 people share it, 100 people believe it. Soon, nobody remembers where it started. Financial markets behave in a surprisingly similar way. A rising price becomes a story. That story becomes excitement. Excitement becomes fear of missing out. And fear of missing out becomes a buying frenzy. By the time reality catches up, millions of people may already be involved. Gold experienced exactly this type of attention. Rising prices attracted headlines. Headlines attracted investors. Investors attracted even more investors. Some people bought gold because they believed in long-term protection. Others bought simply because the price was rising. Those are very different reasons. The first group thinks in years. The second group thinks in days. That difference matters because speculation often creates the illusion of demand. Imagine a town with one bakery. If people buy bread because they are hungry, demand is real. But if people buy bread only because they think the price will double tomorrow, demand becomes fragile. The moment expectations change, buyers disappear. Financial markets face the same problem all the time. Chinese regulators have seen these cycles before. They have seen housing bubbles. They have seen stock market manias. They have seen commodity booms. Every time, the pattern looks different on the surface, but underneath, the psychology remains the same. People become convinced that prices can only move in one direction. History suggests that is usually when risk becomes highest. Meanwhile, something else was happening in the background. Central banks around the world continued paying attention to gold, not because they expected quick profits, not because they wanted to trade daily price movements, but because gold represents something unique. It is one of the few financial assets that does not depend on another institution's promise to pay. That characteristic becomes very valuable during uncertain times. For decades, the global economy operated under a simple assumption. The dollar would remain dominant. Most people never questioned it. Businesses accepted it. Governments accepted it. Investors accepted it. But major geopolitical events forced many countries to think differently. Suddenly, questions that once seemed impossible became normal. What happens if access to parts of the financial system becomes restricted? What happens if countries want alternatives? China was not the only country asking those questions. Around the world, governments began diversifying reserves. Some increased gold holdings. holdings. Others looked for new trade arrangements. None of this means the dollar is disappearing. The dollar remains enormously important, but it does show that countries are thinking more seriously about backup plans than they did a decade ago. This is why the phrase, "China shut down gold trading," became so misleading. It sounds dramatic. It sounds like a declaration of war against gold, but the evidence points somewhere else. Major banks were reducing exposure to leveraged retail precious metals trading, while physical ownership and long-term interest in gold remained intact. Those are two completely different things. In fact, some analysts argue that these restrictions reveal the opposite of what many headlines suggested. If authorities truly believed gold was worthless, there would be little reason to worry about speculation. Regulators typically step in when an asset becomes important enough to create risk. The restrictions may have been less about gold itself and more about protecting investors from extreme volatility. Now imagine being an ordinary investor watching all of this unfold. One headline says gold is crashing. Another says central banks are buying. One expert predicts a massive rally. Another predicts a collapse. The result is confusion. And confusion often leads to poor decisions. That is why the smartest investors spend less time chasing headlines and more time understanding incentives. Because incentives explain almost everything. A retail trader wants returns. A bank wants stability. A regulator wants order. A central bank wants security. A government wants flexibility. All of them are looking at the same asset, yet all of them see something completely different. Once you understand that, the story starts making much more sense. The biggest lesson from this entire situation may have nothing to do with China. It may be about how people react when uncertainty increases. Human beings crave certainty. We want clear answers. We want simple explanations. But financial markets rarely provide either. Most of the time, reality is messy. There are multiple causes, multiple incentives, and multiple outcomes happening at the same time. That is why dramatic headlines spread so easily. China restricts retail precious metals trading sounds complicated. China shut down gold trading sounds simple. People naturally prefer the simple version. Unfortunately, the simple version is often wrong. Understanding what actually happened requires patience, and patience is becoming increasingly rare in a world driven by clicks and algorithms. In the end, this story reveals something fascinating. While millions of people were focused on short-term price movements, governments and central banks were focused on long-term strategy. While traders worried about tomorrow, policymakers worried about the next decade. And while social media debated whether gold was crashing or exploding, institutions continued thinking about resilience, diversification, and risk. So perhaps the most important question is not whether China restricted certain forms of gold trading. Perhaps the real question is this: when governments, central banks, and major financial institutions start preparing for a future that ordinary investors cannot yet see, are they simply being cautious? Or are they seeing risks that the rest of us still haven't noticed? Thinking face. There is another reason this story matters. Most people think financial power comes from money, but in reality, financial power comes from trust. A piece of paper only has value because people believe it has value. A digital number in a bank account only matters because everyone agrees it matters. The entire global economy runs on shared belief. That system works incredibly well until people begin questioning it. Gold occupies a strange position in that world. It does not generate cash flow. It does not pay dividends. It does not invent new technology. Yet for thousands of years, people have trusted it. Entire empires disappeared. Governments collapsed. Currencies failed. Gold remained. That history gives gold something very few assets possess: credibility across generations. Imagine explaining Bitcoin, stocks, or government bonds to someone living 500 years ago. It would be difficult, but show them a gold coin and they would understand immediately. That simplicity is one reason gold remains relevant. It represents value without requiring a complicated system behind it. This does not mean gold is perfect. Far from it. Gold prices can be volatile. Gold can underperform other investments for years. Many investors have lost money buying at the wrong time, but governments often think differently. They are not looking for the highest return. They are looking for insurance. And insurance usually seems unnecessary until the day you need it. That idea helps explain why central banks continue holding gold even in a modern digital economy. They are not betting that civilization will collapse tomorrow. They are preparing for uncertainty. The same reason people keep emergency savings. The same reason companies create create backup systems. Gold functions as a backup plan for countries. Now return to China's situation. If regulators see millions of people treating gold like a lottery ticket while policymakers see it as a long-term reserve asset, conflict becomes inevitable. One side focuses on quick gains, the other focuses on stability. Restricting speculation while maintaining strategic interest in gold suddenly starts making much more sense. But there is an even bigger lesson hiding beneath the surface. Financial markets are full of noise. Every day brings a new prediction. Every week brings a new crisis. Every month brings a new headline claiming the world is about to change forever. Most of those predictions never happen. Yet people keep reacting to them because uncertainty attracts attention. The media industry understands this extremely well. A headline saying, "China adjusts precious metals trading rules," receives little attention. A headline saying, "China shuts down gold trading," spreads everywhere. One is accurate, but boring. The other is exciting, but incomplete. The difference may seem small, but it can completely change how people understand an event. That is why successful investors spend so much time separating facts from narratives. Facts tell you what happened. Narratives tell you what people think happened. Those are not always the same thing. In finance, understanding the difference can be worth millions of dollars. Consider how many times markets have overreacted throughout history. Investors panicked during recessions that never became depressions. Investors ignored risks before major crashes. Investors became convinced that prices could only go up, only to discover reality had other plans. Human psychology has remained remarkably consistent despite advances in technology. And that psychology creates opportunity. When everyone becomes too optimistic, risk increases. When everyone becomes too fearful, opportunities often appear. The challenge is recognizing which situation you are in before the crowd figures it out. That sounds simple. In practice, it is one of the hardest skills in finance. China's gold story demonstrates this perfectly. Many people saw a dramatic headline and immediately assumed something enormous had happened. Others dismissed the story completely. The truth was somewhere in the middle. Restrictions mattered, but not for the reasons many people believed. The event revealed concerns about speculation, risk management, and financial stability rather than a rejection of gold itself. As the world becomes more interconnected, stories like this will become increasingly common. A policy change in one country can affect investors thousands of miles away. A decision made by a central bank can move global markets. A rumor posted online can influence millions of people within hours. Understanding how these forces interact will become one of the most valuable skills of the future. And perhaps that is the biggest takeaway from all. The most important financial stories are rarely the ones people first notice. They are often hidden beneath the headlines, beneath the arguments, beneath the fear and excitement. Because the real story was never simply about gold. It was about trust, incentives, risk, and how governments prepare for an uncertain future. So when the next shocking headline appears, ask yourself one question before reacting. Are you seeing the real story, or just the version that was designed to get your attention? Markets will change. Governments will change. Rules will change. But one thing never changes. The people who look beyond the headlines usually see the future first. Fire.